Hello everyone, my name is Zach and welcome to On Cash Flow, where I help you become a master of your own cash flow. Now let's get started. The short answer to this question is that it depends. Okay, so that's the answer to many things that we have in our life, but it really does depend. And there's no way that I'm going to be able to solve this topic in one video. In this particular video, I can't go as in depth as I would like to because it is such a complex question to answer. But I think I'm going to give you some pretty good pointers when it comes to whether or not you should pay off your house early or not, especially when you're trying to achieve financial independence. And where I want to start is, I want to start with 3 major reasons why you should pay off your house early. Okay, so I kind of want to do like a pros and cons kind of thing. But first off, I only want to start with 3. Like maybe 3 of what I thought was probably the most important reasons why you should pay off your house early, especially when we're relating it to achieving financial independence. And the first one is that it's pretty much a guaranteed rate of return. So when you think of reducing your expenses, if you're able to permanently reduce an expense, then that means that you are getting a return, but you are getting a return in the opposite direction, right? So what matters the most in financial independence is not what your income is, it's not what your expenses is, but what's the difference between that? How much are you investing? What is your savings rate? That is pretty much going to be one of the most important numbers that you have in your life on the path to financial independence. What is your savings rate? And that's going to be pretty much the difference of what you spend versus what you save. And when we're talking about reducing expenses, in this case, paying off a mortgage early, you are locking in a guaranteed rate of return, generally speaking, whatever your interest rate is on your loan. So if you have a 4% APR for your mortgage, then you're locking in a 4% guaranteed rate of return when you pay it off early. And everybody likes guaranteed rates of return. And the higher that guaranteed rate of return is, the better it is for you to pay it off early, generally speaking. The next really major pro for paying off your house early is that once you have a paid off house, once you no longer have a house bill, that means that your F.I.R.E number is going to be much smaller in many circumstances. So you can take whatever your monthly mortgage is and you can multiply that by 25, so that'd be applying the 4% safe withdrawal rule, and that's how much less in assets you're going to need in order to become financially independent, in order to retire early. And so it's obviously much easier to achieve a smaller F.I.R.E number than it is a larger F.I.R.E number. And that can also work not just mathematically, but also it can work for you psychologically. When you're thinking to, let's say, hey, I only have to get to $750,000 instead of $1 million. Psychologically, that is going to feel a lot easier in your head. But also, it's mathematically, it's easier to get to $750,000 than it is $1 million, for example. And then I have major pro number 3. And major pro number 3 is that now that you have a paid off house, you may be able to take on more risk later on. And more specifically, that means that you could probably take on more risk, like more market risk. So generally speaking, if you are entering retirement or you're entering financial independence, general knowledge is to have more of your assets in, like, let's say, bonds rather than in stocks, so that you have a smoother portfolio and you have less volatility. However, if you have a paid off house and you have less expenses, less fixed expenses, then that means that you can be a lot more flexible in your budget. So if half of your budget is flexible and half of it is fixed, then you can play around with that 50% flexible budget. And that means that you can wait out those temporary market downturns if they happen to occur if you have a paid off house, because your fixed expenses are so lower. And I know I said that there's only going to be 3 of them, but I do have a 4th bonus major pro for you real quick. And the 4th major bonus pro of paying off your house early is that it allows you to more easily hit the like button on this video. I'm just kidding. Whether you have a paid off house or not, you should definitely hit the like button on this video if you're enjoying it so far. It really does help me out and I really do appreciate that. But let's get back to it. And now that we're done with the 3 major pros, we can move on to the 3 major cons of paying off your house early. And I think the most important one to note here is opportunity cost. So I talk about opportunity cost all the time because it is very important to know. And the opportunity cost, more specifically when we're talking about paying off your house early, is basically what you could have gotten with that money if you were to have invested it instead. And this might not seem like a lot in a short amount of time, but over time, over a long period of time, it does become a lot more significant. So the general math on this is that you're going to take what your expected return was, subtract out your mortgage rate, your interest rate, and then that's what pretty much your opportunity cost that you're giving up. So for example, if you have a 4% APR mortgage and you expected that you could have earned about 8% over the long run by investing it instead of paying off your mortgage, then you're giving up about a 4% average of opportunity cost on that money that you instead paid off your house early on. Let me go ahead and throw a picture up for you really quick. You can see that this is the example that I'm going to make. You're making some extra payments for 15 years because let's say you paid off your house in 15 years instead of 30. You would have lost $240,000 of opportunity cost. If all of those things were true, if you would have earned more money by investing it instead of paying off your mortgage, then yes, you could have had more wealth at the end of that time period. Now, is that the most important thing? Is it more important to have more wealth rather than have a paid off house? I don't know. That's for you to decide. But you can't argue with the facts that you could possibly lose out on investment gains by instead choosing to pay off your mortgage early. And now we can talk about the second major con that I have for you, and that is that your house is not diversified. It's not a diversified asset. So if you were comparing, paying off your house early to investing in a broad-based stock market index, then you're comparing buying one property in one local area, in one neighborhood, in one zip code, in one county, in one state, in one country. But yes, you're comparing something that is very, very specific, a very specific item in a very specific location versus the total US stock market, for example, that consists of, 3,000, 4,000, 5,000 different companies, depending on which market index it's tracking. By comparison, your house is not a diversified asset. So it is a major con that you're putting all this extra money into an asset that is not diversified. So as far as investments go, it is not a diversified asset. And theoretically, that means that it wouldn't be a very good investment to make. More on that later. But the third major con that I have for you for paying off your house early is that you have low liquidity when it comes to the equity that's in your house. And that is very unfortunate and very unlike investing in broad-based index funds. So if you have broad-based index funds, you can pretty much sell them day in and day out and transfer all of those assets to cash almost instantly, usually in 2 to 3 business days. But when it comes to your house, you have very low liquidity. So having all that money, that's why they say you have money tied up in your house. So that is the equity in your house. In order to get the equity out, you have to borrow money. You have to borrow like a home equity line of credit or do a cash out refinance. Otherwise, if you go to sell your house, it's going to take a lot of time to sell, and also there's going to be high transaction costs involved in that as well. So having a low amount of liquidity in your investments is definitely a con. Beyond those major pros and cons, there's definitely way more pros and cons, and you can leave me some in the comments below. I'd really appreciate that so we can talk about them. Beyond those, there are definitely other factors that you need to consider when you're considering paying off your house early or not, especially when we're talking about achieving financial independence. And another factor that you might have to consider is how much risk tolerance overall do you have. Someone who has a lower amount of risk tolerance, like they can't tolerate risk as much, it might be much better of a decision for them to pay off their house early. Whereas someone who has a much higher risk tolerance and wants to try to achieve wealth much faster, they might want to invest more of their money and try to grow more of that money and take on more risk. So that's going to be a very major factor in determining whether or not you should pay off your house early. Another major factor is, what does the other portion of your investment portfolio look like? How conservative is your portfolio investment already? Because generally speaking, if you're paying off your house early, that's a pretty conservative financial approach to take. Instead of investing the money, you're paying off your house early. That's a pretty conservative investment there. So that's the equivalent of, let's say, investing in bonds. A lot of people like to compare investing in bonds to investing in, paying off your mortgage early, because maybe the interest rate is going to be similar what you expect to make. So what does the other portion of your portfolio look like? Do you already have a significant portion of your investments in bonds? If so, you might be taking too conservative of an approach by paying off your house early. And perhaps once you have a paid off house, you could have less in bonds, as I mentioned earlier, and have more in stocks. Similarly, another ultra important factor to consider is, are you really going to invest that difference? When we're talking about the general population, most of them are going to be better served by paying off their house early. To most people who aren't super investors, like those of us in the financial independence community, the better decision is to pay off their house, because otherwise, what would they have done with that money? Most of them would probably have just spent that money on other items. And so for a lot of people, it is better to pay off their house early, or at least to put extra payments towards their house every single month whenever they can, because otherwise they would have spent that money a little bit more frivolously. frivolously. Yeah, I think I'm saying it right, frivolously. Maybe yes, they would have been better off investing. So if you're watching this video, most likely you would actually invest the difference. And so maybe investing the difference might be a better choice for you. But for the average everyday person, paying off their house might be better, because are they really going to invest the difference? If they're not really going to invest the difference, then yes, pay off your house early. But if you are going to invest the difference, if you're dialed into your finances, which you probably are if you're watching this video, then you have to take a much closer look on paying off your house early or investing the difference. But here are my thoughts. So this is some examples when I would favor paying off my mortgage early. I would pay off my mortgage early if it represented a large percentage of my take-home pay, of my income. So if my mortgage is a high percentage of my income, then I would favor paying it off early, because that means I'm taking on more risk by having that fixed expense. By having that fixed expense that is a high percentage of my, of my income, I'm taking on a lot of risk, because if I were to lose that income, then it's going to be a lot more risky having that large fixed expense. Another one is that if I am looking to retire very soon, or relatively soon, let's say in the next 10 years, then I would favor having a paid off mortgage, because having a paid off mortgage, especially when you choose to retire early or you choose to retire, become financially independent, it's going to give you a lot more flexibility. And so actually, I think that having a paid off mortgage is actually very important, or it can be very important if you are financially independent, if you are retired. And then thirdly, I would favor paying off a mortgage early if I highly valued financial security over maximizing my wealth potential. And in many circumstances, a lot of us do value our financial security. That's why we pay off our debts early. That's why we pay off our car loans even if they're at 1.99%. That's why we pay off our student loans even though they're at 3.5%. That's why we pay off our mortgages even though they're at 4%. It's because we value that financial security of not having those fixed expenses. So for many of us, financial security is more important than ultimately maximizing our wealth. And so those are some reasons where I would favor paying off the mortgage early. Here are some scenarios where I would not favor paying off the mortgage early. If I had a mortgage that was a very small percentage of my take-home pay of my income, then I would favor investing that money more than actually putting it into the house, because even if I did get a lower income, I ended up, losing a job and having to get a lower income job or something like that, it doesn't represent a large percentage of my income anyway, and so I could easily continue to pay off that expense. Likewise, if I wasn't looking to retire for a very long time, then there's no need or no real rush. If I know I'm going to be working and earning an income, there's not much of a rush in order to pay off the mortgage early. So if I'm not looking to retire anytime soon in the next, 10, 20, 30 years, then, maybe I would rather just invest that money and grow the wealth, since I'm going to be having the income anyway. And thirdly, speaking of growing wealth, if growing my wealth, like trying to maximize it almost as much as possible, within reason, taking on a reasonable amount of risk, if that was really important to me, then yes, I would choose to invest that money rather than pay off the mortgage early. And I would actually try to hold on to a mortgage as long as possible, because over the long run, if I know I'm going to live in that house for a very long time, and if I know, I'm going to have that fixed expense and I'm going to be able to afford it because I'm going to be, working, and I want to maximize my long-term wealth, then yes, I would not pay off the mortgage early in that circumstance. It is a very important decision on deciding whether you want to pay off your house early or whether you want to invest that difference instead. I don't have all the answers for you right now, because it is very, very individual. It's going to be up to you what you want to do, what's going to be best for you. Only you can know that. But I want you to realize that it's actually an unfair comparison, comparing paying off your mortgage early to investing the difference, because you're looking at it as if your house is an investment, when in many circumstances, in most circumstances anyway, your house is not an investment. In most circumstances, it's unfair to compare a consumer purchase to an investment. So we need to keep that in mind when we're trying to apply weight to investing versus paying off our mortgage early. Technically, any kind of amount of spending that you do, anything you spend your money on, it could have been invested. So it's unfair to only look at your house and try to make that comparison between, I could pay off the house or I could invest it. It's almost kind of unfair, because you can't fairly compare a consumer purchase to investments. Apples to oranges. I want to know in the comments below, what do you think about this? I know this is a huge topic and there's no way that I could discuss it in one video unless you want me to sit here for like an hour and a half. I don't want to do that right now, and you probably don't want to do that either. But I want to know, what is your take on this topic? Do you plan on paying off your mortgage early? Do you plan on investing the difference? Do you plan on not buying a house at all and just renting for your entire life? Let me know in the comments below. I'm really interested to hear. And then if you are a homeowner, or even if you're not, and you want to know some really cool tips on reducing your housing expenses, make sure you watch this other video that I created. My top 10 tips to slashing your housing expenses. You definitely need to watch that video if you live in a home, which you probably do, hopefully. Thank you so much for watching this video. I'm Zach from OnCashflow.com, and I hope to see you next time.